Welcome to the Deep Dive. We dig into the questions behind the companies you hear about, aiming to give you those key insights. And today we're asking something pretty pointed from our sources. Can a 130-year-old food giant still spice up your portfolio? We're talking Hormel Foods, HRL. You definitely know the name, maybe from Spam, maybe Planters, maybe Skippy, and they're famous as a Dividend King, 59 straight years of dividend increases. Pretty amazing.
It really is an incredible legacy. But look, Hormel is definitely at a crossroads here in 2025. The stock's down, nearly 22% over the last year, hitting 52-week lows, and the big reason, our sources point squarely at these fierce inflationary headwinds.
Right, these costs are hitting everyone, it seems.
They really are. It's a tough time, even for giants like Hormel.
So that's our mission for this deep dive. We're looking at Hormel as of September 1st, 2025. Share price, $25.44. Is this company a resilient powerhouse just weathering the storm? Or, is it maybe becoming a bit of a relic, struggling to keep up? Let's unpack it. First off, what is Hormel really? It's important to get this right. They're not just processing commodities. They're a global branded food company.
That's a key distinction. And they actually restructured back in late 2022, probably trying to get more nimble. They broke things down into three main segments.
Okay, 3 pillars. How are those pillars holding up, especially looking at their latest results, Q3 2025?
Well, it's a consistent story across all three, and frankly, a bit challenging, even though they are selling more stuff. So you've got retail first. That's the biggest chunk, like 62% of sales. Demand there was actually pretty strong sales volume, and net sales both up 5%.
Okay, 5% growth sounds good.
It does, but, and this is the kicker segment, profit actually went down 4%. Selling more, making less profit on it. Those cost pressures again.
Okay. What about the next segment?
That's food service. Think restaurants, cafeterias, that sort of thing. Makes up about 32% of sales. Here, organic net sales growth was even better, up 7%. Strong showing.
But let me guess. Profit issues.
You got it. Same story. Segment profit slipped 1%. Again, rising commodity costs are the culprit cited.
Wow. Okay, and the third segment?
International. It's smaller, only 6% of sales. This part actually had the best volume growth, up 8%, and sales were up 6%.
So maybe a bright spot?
You'd think so, but no. It actually saw the biggest profit decline down a steep 13%.
Yeah.
Sources mention tough competition, particularly in Brazil, and weaker margins on pork products.
So across the board, they're managing to sell more products. People are still buying Hormel brands, but the profitability is getting squeezed everywhere.
That's the core tension, exactly. Successful top-line growth, getting products out the door, but this systemic margin compression is hitting every part of the business. And it doesn't feel like just a temporary blip. It points to real challenges in managing input costs and, frankly, higher overhead selling, general administrative costs. Growth isn't covering the rising expenses.
That profit squeeze really does jump out. But don't they have these incredibly powerful brands? I mean, Spam, Planters Nuts, Skippy Peanut Butter, Jennie-O Turkey, Applegate Naturals, W.I. Holy Guacamole for food service, Hormel Pepperoni, Fire Braised D-Meats. Doesn't that give them some pricing power, some defense?
It absolutely does. That portfolio is massive, and it's the foundation of their market power. We're talking a market cap around $13.99 billion, pulling in over $12 billion in revenue a year. And they're number one or number two in so many key areas: shelf-stable meats, pepperoni, guacamole, peanut butter. It's impressive.
So that translates to real value, right?
Yeah, their value proposition rests on a few things. Accessibility, you can find their stuff in over 75 countries. Value, decent quality for a reasonable price. And brand and status, I mean, people have trusted these names for generations. That loyalty does help. It provides some insulation, but even strong brands struggle when costs keep rising this much. There's a limit.
Okay, let's zoom out a bit. How does Hormel fit into the bigger picture? What's happening in the food industry overall?
Well, you've still got this persistent food inflation. The USDA is forecasting, 2.9% overall food price hikes in 2025? And even higher, 3.9% for food away from home restaurants and such.
Which directly hits Hormel's costs and potentially helps their food service segment sales, right?
Exactly. It's a double-edged sword. And speaking of food service, that market is projected to grow really strongly, like 7% compound annual growth rate through 2032. That's a significant tailwind if Hormel can capture it profitably.
And what about us, the consumers? How are our tastes changing?
Oh, big shifts there. You hear terms like precision wellness, people wanting food tailored to their health needs, gut health is huge, demand for natural ingredients, and also, sort of paradoxically, wildly inventive flavors. People want novelty too.
So how is a 130-year-old company like Hormel trying to keep up with all that?
That brings us right back to their strategy, particularly acquisitions. Buying Applegate, Justin's Nut Butters, and especially that massive Planters deal, those weren't random. They were deliberate moves, pivots, really, towards these exact trends. Snacking, wellness, more premium offerings. Whether they can successfully integrate and profit from this shift, well, that's the million-dollar question for the long-term investor.
Makes sense. Now, this packaged food space is notoriously competitive, right?
Right.
Hormel's up against absolute giants like Tyson Foods, Kraft Heinz.
Yeah, Tyson's got like $53 billion in revenue, Kraft Heinz around $26 billion. Hormel at $12 billion is smaller.
Is that a disadvantage, being smaller in that arena?
It can be, but Hormel's historically punched above its weight in profitability. Their net margin, around 6.26%, is actually pretty good for this sector, often better than some larger peers. Plus, there's a significant moat, as they say, protecting established players like Hormel.
A moat. What does that mean in food?
It means high barriers to entry for newcomers. Think about the massive cost of building factories, setting up distribution networks nationwide, achieving economies of scale. Then there's brand loyalty. People are often really attached to their specific brand of peanut butter, like Skippy Y. That's a kind of switching cost. And you've got complex regulations from the USDA, the FDA. It's tough for a startup to crack.
So the moat helps. But you still need good leadership navigating these changing waters, right? Who's at the helm?
Leadership is critical, especially now. They actually had a CEO change this year. James Snee retired, and Jeffrey Ettinger stepped back in as interim CEO. John Gingo is president.
Ettinger. That name sounds familiar with Hormel.
It should. He was CEO before Snee, and he guided a lot of the acquisitions that really shaped Hormel's current portfolio. Skippy PY, Applegate, over 10 deals in total. His return suggests a focus on stability and executing the strategy during this tricky period.
And their strategy heavily involves M&A, mergers and acquisitions.
Absolutely. It's consistently been their top priority for capital. The Planters deal in 2021 was huge, $3.35 billion, their biggest ever. And that wasn't just about getting bigger, it was transformative. It shifted about 25% of their product base away from meat. That's a major pivot.
Are they investing internally too? Or just buying companies?
No, they're investing internally as well. They've budgeted around $300 million for capital expenditures in 2025. That's for things like expanding production capacity and modernizing technology, trying to get more efficient to fight those cost pressures we talked about.
And efficiency ties back to profit, which ties back to the dividend. We have to talk about the Dividend King status. 59 years of consecutive increases. That's just remarkable commitment to shareholders.
It is. And the current dividend is $1.16 per share annually, yielding about 4.56%. That's definitely attractive in today's market.
Is there a but coming?
There's a pretty significant but. That very commitment, that dividend-first approach, is under a major stress test right now. Because profits have been falling, but they've kept increasing the dividend. Well, the payout ratio, the percentage of earnings paid out as dividends, has ballooned to roughly 84%.
84%? That sounds high.
It is high. It leaves very, very little room for error. Profit recovery isn't just desirable. It's pretty much essential to keep that streak going and keep growing the dividend.
So the dividend itself might be okay for now, but future growth could be capped.
That's the risk. And it's not just the dividend payout. Look at their return on invested capital, ROIC. It's a measure of how efficiently they generate profit from the money invested in the business. That number has fallen sharply, from 12% back in 2020 down to just 6.49% now. That tells you they're struggling to get good returns on their investments, including that big Planters acquisition. It adds another layer of concern.
Okay, let's just recap the key numbers quickly. As of September 1st, 2025, market cap $13.99 billion, revenue $12.06 billion, TTM, PE ratio 18.57, that dividend yield 4.56%, debt to equity being 3.5, and a current ratio of 2.47.
Right. And drilling into those financials a bit, revenue grew strongly in 21 and 22, mostly thanks to Planters, but then declined in 23 and 24. It's sort of stabilized recently. But the margins, gross, operating net, show that consistent squeeze we've been discussing. Gross margin down from 19% to 17% over 4 years. Net margin down from nearly 8% to just over 6%. That's the core issue.
Jet cash flow.
Volatile. Free cash flow actually went negative in 2021 because of the cash spent on Planters. And it was really low, just $5 million in 2024. Big M&A definitely shakes up the cash flow picture.
Okay, shrinking margins, bumpy cash flow.
Right.
But you mentioned debt to equity was low, 0.35. Is the balance sheet the good news story here?
Yeah, absolutely. That's Hormel's rock. They are very conservative with debt. That low debt to equity ratio means they aren't over-leveraged. And the current ratio, 2.47, is exceptionally strong. It means they have plenty of liquid assets to cover their short-term bills. That financial foundation gives them breathing room, resilience.
So how's the market pricing all this in? That PE ratio, 18.57, is that high or low for Hormel?
Interestingly, it's about 22% lower than Hormel's own 10-year average PE of around 24. So historically speaking, it looks potentially attractive. Compared to its peers, it's kind of in the middle, cheaper than Tyson, pricier than Conagra.
And what about intrinsic value? Like, what might the company actually be worth based on its future cash flows?
Right. So using a standard discounted cash flow or DCF model, and remember, this is educational, based on our conservative assumptions, like modest 2.5% revenue growth, 2% terminal growth, using a 5.4% weighted average cost of capital.
Okay, got it. Based on that.
Our model suggests an intrinsic value range of roughly $28 to $33 per share.
Which is notably higher than the current price of $25.44.
It is. Now, Wall Street analysts seem to agree, generally rating it a buy with average price targets in that 30-33 LR range, suggesting, 20-30% upside potential.
But the headlines haven't been great.
No, the media sentiment is definitely mixed. Lots of focus on the 52-week lows, the profit warnings, and the technical chart signals. Unambiguously bearish. The stock's trading well below key moving averages, the 50-day and 200-day.
So it's a real clash, isn't it? Potential long-term value versus very negative short-term momentum.
That's the classic dilemma right there, value versus momentum.
Okay, let's try to pull this all together. Strengths and weaknesses, opportunities and threats, the SWOT analysis. Strengths, powerhouse brands, #1 in many categories. That's solid balance sheet, the Dividend King legacy, economies of scale.
Right, and weaknesses. Those squeezed profit margins, the stalled growth in revenue and earnings recently, and that high dividend payout ratio creating risk.
Opportunities.
Opportunities include growing the snacking business with Planters, tapping into that strong food service market growth, finding cost savings through their internal transform and modernize efforts, and aligning more with those wellness and convenience trends.
And the threats.
Intense competition, always. Consumers changing their minds quickly. Supply chain disruptions are always a risk. But the big ones, the immediate ones, inflation is #1, hammering margins right now. And then these proposed tariffs, 25% U.S. tariffs kicking in August 2025. That could really make inflation worse for things like canned goods and maybe hurt exports if other countries retaliate. Management says they think it's manageable, but it's a definite threat.
So the bull case boils down to great brands, financially strong, rewards shareholders, looks cheap historically, and they're actively trying to pivot. Sounds solid.
It does. But the bear case is just as clear, maybe more urgent. Profits are getting squeezed now. Growth has stalled now. Dividend growth is questionable now. Integrating Planters successfully isn't guaranteed. And you have inflation and potential tariffs clouding the immediate future. The market seems focused squarely on these bear points.
Which brings us back to the current price, $25.44, trading below that estimated intrinsic value range of $28.33. Maybe the market is being too pessimistic about the short term.
From a pure value perspective, you could argue that the current price seems to undervalue the long-term strength. Those brands aren't going away. The balance sheet is solid. However, and this is crucial, you, as a prospective investor, have to weigh that potential undervaluation against the very real, very immediate risks. The inflationary pressure is undeniable. The Planters integration needs to deliver better returns. These are significant hurdles.
It really is a balancing act. Potential value versus current pain.
Exactly. It's a tightrope.
So, the final thought for you listening. What does this mean for you? Is Hormel Foods that sweeping giant, poised for a comeback once these headwinds ease? Or has its legendary stability perhaps become a bit of a drag in today's fast-moving market? And critically, how much patience do you have? How long are you willing to wait for a Dividend King facing maybe its toughest stress test in decades, where just maintaining that dividend streak is a challenge, let alone significantly growing it? Think about where that long-term value story meets the immediate bumps in the road and how that fits with your own approach to investing.